Hello, I'm Bernard Hickey from interest.co.nz and welcome to an extended special report on the Reserve Bank's September quarter monetary policy statement and its 50 basis point cut in the official cash rate to 7.5%. Now this was a surprise. Most economists, in fact 16 out of 17 surveyed, expected a 25 basis point cut. So this is twice as big as people expected. The currency has already reacted. It's dropped nearly a cent US to 65 cents or so. And you'd expect that because international investors often buy New Zealand dollars because we have high interest rates. With those interest rates dropping, we're not so attractive, particularly against the likes of Brazil and South Africa, where interest rates are 12 and 13% respectively. So what's the Reserve Bank doing here? Why have they decided to cut interest rates more than expected? Well, Bollard said in a press conference after the announcement today that he is seeing the global economy slowing more than he expected previously, and the New Zealand economy therefore is slowing. He's now expecting the recession to go right through the March, June and September quarters before we see a slight rebound in the December quarter. A couple of reasons for this. Commodities prices, particularly for dairy, are starting to drop off. The housing market is in deep trouble. Interesting today, the Reserve Bank has increased its forecast for the fall in house prices. Previously they expected a 13% fall. They're now saying house prices will fall 15% from their peak, and we're only halfway through their fall. They see a trough towards the end of this year. That's depressing spending in the consumer sector. He is expecting, though, a bit of a lift to come through from the tax cuts expected from October 1, and that's why he's saying that GDP will grow around about 0.4% in the December quarter before picking up. They also see a lift in inflation through 2009 and 2010 as the effects of the emissions trading scheme starts to kick in. In fact, the Reserve Bank is forecasting 3.0% inflation in 2011. Remember, the Reserve Bank is supposed to target between 1 and 3% for inflation. So, what does this all mean for interest rates that borrowers will face and the exchange rate? Well, firstly, interest rates. Interestingly, the Reserve Bank governor said today that one of the reasons for the 50 basis point cut was to give the banks plenty of room to pass on cuts to regular borrowers. That's because international funding costs have increased for banks because of the global credit crunch and because we borrow so much offshore. So, Reserve Bank Governor Bollard is saying that the banks have quite a bit of room to pass on cuts to borrowers, both in fixed term rates and in variable rates. Remember, after the July 24 cut, banks didn't pass on the cut to variable rate borrowers. They did, however, for fixed rate borrowers. We'll see later today whether or not the banks do pass on that cut. I'd expect they'd pass through at least 30 of the 50 basis points, certainly for their fixed rate mortgages. And for the currency, well, you'd have to expect it's on a downward trend, down through 18-month lows to 65 US cents, and later tonight when the Europeans get a look at it, you'd expect it to fall further. That was an extended monetary policy report from the Reserve Bank in Wellington. I'm Bernard Hickey for interest.co.nz.